Okay, so you've taken your second exam, you're over halfway through, two-thirds of the way, and now for something um, a little more relaxing, because this chapter is relatively short. It's like 30 pages or so, but we're just going to cover some of the easy highlights, not too stressful, so you can ease into this next unit. It's going to be a great end of the semester, I'm pretty sure. So let's talk about at risk. Okay, before I really go into at risk, let's talk about what this chapter is about. It's about investor losses. So what this does is it helps us determine whether or not we can take a loss on certain investments. Okay, and let's see. So we're going to cover a lot of the tax shelter stuff. So as you know, people who are really savvy in the tax law try to look for ways to avoid tax. So they try to look for loopholes in the code, just for the pure motivation of avoiding tax. Imagine that. Okay, so here's one guy from Yale University. I don't know if this is in your textbook. I've got it written down here. Michael Greats, I think that's how you say his name. He said a tax shelter is a deal done by very smart people that, absent tax considerations, would be very stupid. So essentially, it's a plan. It's like a business activity that doesn't make sense, but to avoid taxes because of how the code's written, it makes sense because they can avoid tax. But otherwise, without tax motivation, it would be stupid. So I like that quote. It simplifies things. So we have in general we have three limitations. So the limitations on losses, that is. So our three limitations. Now shoot, I can't write. We have the basis limitation, the at-risk limitation, and then we have the passive loss limitation. So those are the three limitations we have when we're determining whether or not we can deduct a loss. Now, in this class, for the most part, you're going to assume that 1 and 2 are always the same. So there's some things that can make these unequal, to where your basis is not the same as your amount at risk. But you don't need to really worry about them for this course. So we'll talk more about that in the if you take the corporate class. So essentially, we're just going to be looking at these two, at risk and passive. So let's discuss how to calculate how much you have at risk in certain investment ventures or business ventures. Alright, how to calculate this. Oh shoot. So here we go. You're going to put money into a business as like an investment. So how do you determine how much you have at risk in that investment? Well, you have however much cash you put in, so cash contributed, plus the adjusted basis of property, so that's contributed property. So say you put some equipment or you put some buildings into a business as a property contribution. Well, you would increase your basis by the basis you have in the property you put in. And then any shares and liabilities. Okay, so in addition to contributing property, you also take on a share of the debt that is in that entity, or you borrow against your personal liability. So you borrow, and then, or you borrow for the business, and the liability's on you. So that's essentially it. Okay, and then in addition, hold on a second. All right, in addition, you're going to increase for your share of income. And then decrease for share of losses. Okay, so that's in general how you calculate the amount that you have at risk. Let's do a basic example. So let's take Ed. Ed acquired a partnership interest for $50,000 and became a material participant in the activity. So he contributes 50,000 bucks cash contribution. All right, and so he's a material participant. When I say material participant, that basically tells us that he is not going to be subject to the passive loss limitation. So material participant tells us that it's non-passive. It's not a passive activity, so he doesn't have to worry about that limitation there. Okay. So let's go on, and then in addition to that, he takes on a liability. So he says, "All right, this liability of the partnership is on me for $20,000." So that's his share of liability on the partnership. So that means that his risk amount is going to be a total of $70,000. He has this much at risk, $70,000. So it's the cash he put in plus the debt that's on him, the partnership debt that he's guaranteeing. All right. Awesome. Now let's talk about taking a loss on that. So let's say that there's a loss of $50,000. Okay, if that happens, he can deduct that loss, alright? Because, well, why can he do it? Well, we have two general limitations we're looking at, either at risk or passive. We don't have to worry about a passive limitation. So we just have to worry about the amount we have at risk. He has $70,000 at risk. So what will happen is we'll take his at risk. We'll take a deduction up to his at risk amount. Well, the loss is only $50,000. So we'll deduct that, and then his amount at risk after taking the loss will be $20,000. So now if we do another scenario where there's an $80,000 loss, let's go back to the same amount. So let's take his initial at-risk amount before taking the loss of $70,000. We will take a loss deduction up to his at-risk amount. That takes his at-risk to 0. And then after that, okay, we still have $10,000. What's going to happen to that? He doesn't lose it forever, but that amount turns into a suspended loss, and it'll carry over to future years until he has enough amount at risk to cover the $10,000. So it'll be suspended until he increases his at-risk amount, and that can either happen with additional property contributions, future profits in the business, an increase in share liabilities if they take on more partnership debt. But that's generally how it works. So let's do a problem So we're going to do number 33, future profits. Oh, that was so awesome. I love it. This is awesome. Tax is fun. I don't care who you are. Well, I guess if you're a pop star, maybe tax isn't so much fun. Seems like singing for millions of dollars would be like more fun than doing tax. Let's see, what next? Okay, we'll talk about passive. What the heck does that mean? Okay, we have, in general, just under this umbrella here, we're going to talk about the three general types of income that you have from a tax perspective. So, from the IRS point of view, you have active income. What is active income? Some examples. Wages from your job, wages/salary. Bonuses. Profit from a trade or business. And yeah, that's basically it. Profit from I think we can stop there. Now let's go to portfolio income. I'm writing a little messy here. Forgive me. Forgive me. Okay, so that's pretty obvious. It's all the stuff that you would get from savings accounts, stock accounts, like where you're trading stocks, buying and selling stocks, dividends from stocks, royalties from investments like in rental or from oil producing properties. Yeah, so it wouldn't be rental. It'd be royalties like from an oil and gas property or something else. So let's write that down. Interest, dividends, gains and losses on sales of stock. Stock in general, there's other property, other investment property that you can have other than stocks, like land that you're holding for an investment. That would also give rise to portfolio income. Okay, now let's get to the last one, the passive income. So passive is any trade or business producing income in which the taxpayer does not materially participate. Okay. So income from trade or business does not materially participate. Sorry, my daughter's whining in the background. She's trying to cry herself to sleep. Forgive me if you hear that faintly. Poor soul. Let's see. All right. Okay, so let's talk about this. So why is this considered passive, and why does the government limit your losses for this particular type of income? Well, I guess The way I think about it is the IRS assumes that if you're materially participating in the day-to-day operations of a business, that you're more likely to try to have it produce a profit. Okay, so if you're not there firsthand and you're basically the owner, but you're not there from day to day, then you're not going to be able to ensure that there's as much of a profit. So it would be like me if I were like a millionaire or something like that, and I would go up to a friend and say, "Hey, you want to go into business?" And he says, "Yeah, sure, yeah, I'd love to." It's like, "Well, how about I go and buy like one of the bars on 6th Street and have you manage it? What do you think about that?" He'd be, "Oh, that'd be awesome." And he could be, just a friend of mine that I've known for a long time. He could not have any management experience, any experience running a bar whatsoever. He just gets in there and can fly by the seat of his pants, and the place is just bleeding red ink. And I'm not altogether that broken up about it because I've got income from a bunch of other sources because I'm a millionaire, and I'm just going to take a loss on that bar that he's running and wash out my other investment gains. Well, the IRS doesn't want you doing that. Okay, they want to make sure that you're there from day to day, kind of making sure that income's being made, because they think it's more likely to happen. And I guess it's also a way to favor more of the mom and pop businesses, because if you could be a business owner, and if it's like a mom and pop, like a small business, that's going to be the only business you have. Okay, so it helps. It helps be fair to the mom and pops who have their own business, and that's it. That's their lifeblood. That's their bread and butter, and so they get to take a loss if they're actively participating in it. Okay, so I may have gone into too much detail and speculated too much on that, but that's essentially how it works. Okay, there's an exception here. So we talked about a trade or business, but let's talk about rental real estate. Rental real estate activities are going to be passive. Whether there's material participation or not, those are always going to be passive. All right. Okay, so now what do we do? What do we do? All right. I'm just going to refer you to some pages in the book real fast as far as the tests as to how the IRS determines whether you're actively participating or not. So there are 7 tests, and they're listed on page 11, 18 through 11:20. Yeah, 11:20, I think. That's what I'm seeing. Alright. So I'll let you go through those. And then that'll bring us to our last topic, which will help us discuss more of the rental activities. Okay, so first thing we'll say is all passive. And there are 6 exceptions to this. Okay, so these we got 6 exceptions to the whole rental being passive. Let's see. So another word for these 6 exceptions is not much rental. So the first one here is if you rent the property for 7 days or less. An average of 30 days or less, or the average period a customer uses the property, 30 days or less. Significant services are provided by the owner of the property. Let's see, I'm basically just spouting off what's already listed in the chapter here. The owner of the property provides extraordinary personal services. Average period of customer use is of no consequence. So these are on. Oh, you know what? Oh my lord. Alright, so I essentially screwed up my page numbers here. So these up here, these 7 tests. I'm sorry, I'm a little out of it. Those first 7 tests are on pages 11, 14. And you probably already discovered this. You're probably like, yeah, we saw it. Yeah, we can read. 11, 14 through 11, 16. Okay, so these are 6, and these are on 11, 18 through 11, 20. No, 11, 19. Okay. So I'll let you read through those. The owner of the property provides extraordinary services. For the rental property is treated as an incidental to a non-rental activity. Lodging rented for convenience of an employer. Taxpayer customarily makes the property available during defined business hours. Property provided for use in an activity conducted by partnership, S corp, or joint venture. Blah blah blah. Have fun with that. Let's talk about real estate professionals. If you are a real estate professional, then you'll treat income from real estate, rental real estate, as active income. So how do you determine if you're a real estate professional? More than half of the services performed are done in real estate. And then over 750 hours of participation. So that's another exception. If you're a real estate professional, you can treat rental real estate as active income. Alright, let's go back to the passive. So the IRS decided to give folks a break. if you're not a real estate professional, but you actively participate, you can take up to a $25,000 loss. And that's per year. So you can take up to $25,000 against active income per year if you've got a passive rental and you're not a real estate professional. This is subject to a phase out. Okay. Alright, so if you're married filing separately, it's not allowed. Okay, so that's not really a phase out, but it's just an exception. But the $25,000 that you normally get as a deduction phases out by 50% of your AGI in excess of $100,000. Okay, so it goes away 50 cents on the dollar for every dollar over $100,000 of AGI. Right, as if that weren't complicated enough. But that's it. That's all we really have to talk about. Let's do an example real quick, or a couple of examples.